2 years, half the growth that we've seen in output and employment and income really came from all that fiscal stimulus. Even connecting the dots to job creation, this was the gift that kept on giving. It was the Energizer Bunny effect. A $2.2 trillion income relief, virtually unprecedented. History showed that when the household sector, the benevolent consumer sector in the United States, what I call Consumerica, even with their wild spending habits, history shows that when the household sector confronts a massive fiscal transfer, like what Uncle Sam did in terms of that degree of generosity, historically, the household sector spends half and saves half. And that's why the Biden team went so big. But you see what happened in this new, even more narcissistic economy than we've had historically. YOLO spending, anger spending, revenge spending, all this post-COVID developments. All that money got spent. Like, who would have thought that we'd be sitting here today with the personal savings rate at 3%? 3%. Historically, Americans, out of every after-tax dollar they earn, they put 10 cents in the piggy bank. Now they're putting in 3 cents. So this is very important. It's almost like when you're an equity market analyst and you're looking at expected future returns, you have to know what the valuations are. The higher the valuation, the more your future return has already been absorbed in the here and now. And so as an economist, when you look at the savings rate, which I would argue is one of the most important behavioral aggregates that comes out of the national accounts data, at 3%, you're at rock bottom. We've borrowed a lot of growth from the future. So when you're taking a look, for example, at the rock bottom savings rate, which means that households now are going to have to rely more on organic income as opposed to drawing down their savings rates. We know that the banks on both sides of the border are radically tightening their credit standards. So it means that it's going to be a lot tougher for households to access credit to spend. And then we know that cracks are starting to emerge in the labor market. The labor market's not collapsing, but cracks are emerging. And the unemployment rate is going up, both in the US and Canada. And with a lag, that's going to exert downward pressure on nominal wage growth, which tells me that all roads lead towards a much slower consumer spending profile in 2024. I think that because this particular Fed was so shamed with the bulge we had in inflation and having turned so amazingly hawkish and sounding so hawkish. I remember back on September 20th, they actually raised their dot plots to put in an extra rate hike for this year, which obviously isn't going to happen. But for this Fed and the hubris, for them to move that quickly in the first quarter, I think they're going to probably want to bide their time, because that would be a mea culpa of historical proportions to move that quick. I think that Bill Ackman's right. I think that they probably should cut rates in the first quarter. I think that they're going to wait as long as they can. But the reality is that we're just talking about the difference of 2 months. The historical record shows this. The historical record shows that every easing cycle is followed by a pause, and then a tightening cycle, followed by a pause, and then an easing cycle. And because interest rates move in cycles. And so we've been in the pause period since July. That was the last rate hike, despite all the bravado and all the hawkish musings up until just this past week. The Fed's last rate hike was in July. And what makes the December meeting really important is that if they skip December, and it looks like they're going to have to, that will make it 5 months where the Fed has been on the sidelines after a tightening cycle. Historical record shows that if they wait 5 months after the last rate hike, and they're on the sidelines for 5 months, then the game is over. As they say on the Quebec side of the border, les jeux sont faits. And the next move is always a rate cut. The question is, what's the lag? And usually the lag from the last rate hike to the first rate cut is 10 months. So you add 10 months to July, it puts you in May. Well, what do you know? That's what the markets are actually priced for right now. Bill Ackman may be right on March, but if he's right on March, even though I'm saying 2 months isn't that big of a deal, but things are going to have to go sour really quickly, considering where we are right now in December, for the rate cuts to start that early. But it doesn't come then, it'll be in the second quarter. And then it's going to be a question is, how far are they going to go on the rate cutting cycle? And that's what we're going to be talking about through most of next year. One of the most ridiculous things I've ever heard. How do you come up with that prognosis? China is in a mess. You're looking at the data in China, you're looking at the credit contraction, the debt implosion, the property market malaise. Looks almost like the US did back in 07 and 08. This is the world's second biggest economy. They are not maybe on a technical recession, but getting close. Germany is heading back in recession. The UK is stagnant. The next move is a recession there. And of course, Germany is the engine for the entire EU. And then you got Japan just came off a negative quarter GDP. With this view, I mean, we're going to be getting a number on Friday in Canada, or tomorrow. We're going to be getting a number on GDP. GDP growth in Canada has vanished on a year-over-year basis, down to 1%. And I look at Canada because it's a torque on the global economy. So the last man standing has been the U.S., and the U.S. has been breathing fuels. No country stimulated the fiscal side like the U.S., and that money couldn't all be spent at once. And a lot of it got spent in 2023, but that game is over. So
well,
yes, there's going to be, of course, there's going to be a hard landing. You know, it's hilarious almost that you hear these people saying, oh, every economist and their mother threw in the recession towel just in the past several months. Why? Well, the recession hasn't happened yet. And then they dream up all these reasons. Oh, that interest rates don't matter anymore. That policy lags don't matter anymore. The economy has somehow become impervious to interest rates, which is the most ridiculous thing. That is the most ridiculous thing. So everybody dreamt up reasons. It reminds me in 07. In 07, when I was at Mother Merrill, pounding my fist on the table all that year, and everybody saying to me, Rosenberg, where's the recession? Where's that hard landing? Where's that? In fact, you're talking about the OECD. Please, were they calling for recession in 08? The OECD and everybody was talking about global decoupling. Even after the US went into the recession, that nobody saw happening. But the recession came in December of 07. And it came later than I thought. But you see, the reality is that if I have a flaw, and I have several, but I'm usually early to a fault. But to suggest that we're not going to have, well, we'll call a hard landing as a recession. And a recession is part of the business cycle. And it's not a fairy tale. Thankfully, the economy historically expands 85% of the time. Thankfully, recessions only occur 15% of the time. But if you're a business cycle theorist, if you're trying to get clients out of trouble for a 12 to 24 month period, now this is what we're looking at. But to say that I'm not calling for recession, because the recession hasn't happened yet, is like telling people in December in Toronto or in Vancouver or anywhere in Canada, hey, it didn't snow in December, therefore winter's been called off. It is to tell me, it's like to tell me that the business cycle's been repealed. And it's to tell me, maybe the best economist of all time was Albert Einstein, who famously said that the power of compound interest is the eighth wonder of the world. And interest rates work their way into the economy with lags that are variable. This cycle was elongated. So was the cycle in 07. In 07, it wasn't about you only live once, YOLO spending, revenge spending. It was about tapping your home equity line of credit for the last time, the last vestige of the housing bubble, kept the economy chugging along. But the recession came in December of 07. Right. And people didn't start calling for the hard landing, till Lehman collapsed. So, come on. It's next year's going to be a recession year. It's not the end of the world. It's not a medical diagnosis. It's part of the business cycle, and there's no asset class that's really fully priced for it. That's what's important. The recession is only a horrible thing if you're not prepared for it.
Right.
Other than that, they're short, brief affairs, but just be aware that next year is going to be a hard landing year. That should be your base case scenario. I think Canada is unique in a sense that it had one of the biggest housing bubbles on the planet. Even bigger, when you're taking a look at most valuation metrics for residential real estate, it was a bigger bubble than it was in the US back in 06 and 07. And you have a massively indebted household sector. So Canada really stands out. Everybody talks about Canada's got a debt crisis. And then they look to Ottawa and they say, look at the Liberal government, they'll look at the fiscal side. No. The debt crisis in Canada is on the household balance sheet. Over 170% debt to income ratio for the household sector is 35 percentage points higher than it was at the peak of the credit bubble in the U.S. back in 06 and 07. That's what the problem is. But Scotiabank, so they know what's going to be happening. And you could say it is prudent to try and get ahead of the curve. The banks will be raising their reserve positioning probably for the next year. It's not over yet. And the banks are going to be constricting credit because they do have to respond to their shareholders. And that's going to have an impact on consumer spending. But more to the point, we came off in the US the tightest monetary policy, the biggest increase in interest rates since the Volcker years. Well, if memory serves me correctly, we had some pretty serious recessions in the early 1980s. We just came off in Canada the most acute tightening cycle since John Crow. Now, the reality is that when I asked most people in Canada, about John Crow, they don't know who I'm talking about. But I imagine that you and I know who we're talking about. We had a central banker radically fight inflation. We got a huge recession in the early 1990s. And so what's happened here is that we have a situation where 15% of Canadian household incomes are now going to service their debts, which doesn't sound like a huge number, but remember that over 30% of Canadians don't have any debt. That's an aggregate number. For debtors out there, that ratio is a lot higher. But in the aggregate, we have a situation where 15 cents out of every after-tax dollar is going to pay interest on the debt. Doesn't sound high. Yes, it's almost at a record level. The last time we were close to this level was before the 2008 recession, before that, just ahead of the 2001 recession. And what I point out to people is that, did you know when I mentioned John Crow, and he took interest rates were at 13% back in 1990, it was more like 12 cents of every dollar going to service interest, service the debt. It's up to 15 cents now with a 5% policy rate. And see, that's what happens here. Is one thing about carrying this amount of debt, 172% of GDP of disposable income is insane. It's amazing that anybody could have let this happen. But you see, everybody thought rates would stay at zero forever and you can carry that debt at zero rates, but rates aren't at zero anymore. We're going to have a very serious delinquency and default cycle. And we're going to have in residential real estate, despite the banks being pressured by the government to make sure that people stay current, it's a dam that's going to break. So there's going to be a lot of property being transferred from weak hands to strong hands, but we're going to have a very significant real estate deflation. The banks are going to be compelled in an environment of asset deflation and rising delinquencies to tighten up on their credit standards, which then affects everybody else. So securing a loan is going to be a lot more difficult. And then we have to talk about what will happen on the employment side. And you're starting to see cracks in the labor market in Canada too. The unemployment rate in Canada has gone up at 8 percentage points, from 4.9% to 5.7%, from the cycle low to where we are right now. That is a foolproof 100% recession indicator. And so that's going to have an impact as well on wage growth. So we're going to have these ongoing heavy interest payments because the Bank of Canada, once again, is going to be slow like the Fed. And we're going to have these interest payments, which are already at a record high relative to disposable income, at a time when the income, the denominator, is going to be weakening because we're going to be seeing rising unemployment. So this is not a very good setup for Canada for 2024. And in fact, I would say that things here are going to be a lot weaker than they are in the States. And the States won't be a pretty picture either, but it's going to be worse here. And that's why I remain fundamentally bearish on the outlook for the Canadian dollar. My approach is to stop looking at the inflation numbers that they look at. I don't know why we're focused on the CPI number when the major source of inflation in Canada, believe it or not, is mortgage interest. When I tell people that mortgage interest is in the CPI, they don't believe me. I have to show it to them. And it's like, mortgage interest, that component of the CPI is up 31% year over year. And that's it's the craziest thing because it's like the Bank of Canada creates the inflation, raise rates, mortgage rates go up. What do you know? It shows up in inflation. When you exclude mortgage interest from the CPI, it's only a 5% share of the index, but it's going up asymptotic. That inflation is almost at 2%. Like inflation X mortgage interest is already practically back at the Bank of Canada's target. And the last time that it was here, the ex-shelter inflation rate in Canada, the ex-shelter, and shelter is a very tricky thing to estimate when you're trying to do hardcore inflation. And every country does it differently. In the United States, they do basically owner's equivalent rent or imputed rent. You know that in the United States, they actually ask homeowners what they think they could rent their house out for. And that goes into the CPI in the United States. In the United States, when you strip out shelter, inflation's 1.5%. Where's this new era of higher for longer inflation? Where is that? Ex-shelter inflation in the United States is 1.5%. Ex-shelter inflation in Canada is 1.9%. And I'm being asked about the secular trend in inflation. These numbers are lower than they were pre-COVID in February 2020, when the policy rate in Canada was 1%, not 5%. So I don't know. I would say my advice to the Bank of Canada is take a more eclectic view of where inflation is and where it's heading. But But I think that the Bank of Canada, and include the Fed, have deliberately put themselves behind the 8 ball, and they'll be scrambling significantly to cut rates next year. That's why, Bill Ackman, is it March? Is it May? To me, that's noise. The real question is, after we now have evidence that we've had the peak in rates put in, and that higher for longer was as transitory was, how far are they going to have to cut in 2024 and 2025? That is what we should be spending our time thinking about.